So, picture this. You wake up, you check the markets, and suddenly a 1,000-point plunge is staring you right in the face, sending these massive shockwaves through the entire Indian economy. Now, this wasn't just a bad day, not by a long shot. It was a cascade of events that actually started thousands of miles away. So how on earth does a global conflict trigger such a massive sell-off right here at home? Well, let's unpack that chain reaction.
This was the number that was just flashing across everyone's screens, minus 1,097. That's a drop of almost 1,100 points on the BSE Sensex, the index that tracks 30 of India's biggest companies. We're talking billions in value just poof, gone, at least on paper. But a single number like this, it rarely tells the whole story. To really get what happened, we got to dig into the details.
Okay, so while the big indices were down, the real story is buried in these numbers. The Sensex fell 1.37%, the Nifty 50 dropped 1.27%, but look at the Nifty Bank Index. It plummeted a staggering 2.15%. Now that tells you something important. The sell-off wasn't random at all. It was targeted. Something specifically spooked investors about the financial sector. So, let's go find the trigger.
To find the spark that lit this fire, we actually have to look way beyond India's borders. The story of this market crash, it really begins with global conflict and, you guessed it, the one commodity that can hold the entire world economy hostage, crude oil.
The headlines that day were painting a pretty tense picture. There was escalating conflict in West Asia, specifically between the US and Iran, and that immediately sparked fears of a huge disruption to the oil supply. Of course, that kind of uncertainty spooks global markets right away, and it adds what traders call a war premium to the price of oil.
So what exactly is a war premium? Well, you can think of it as risk that's been translated directly into dollars. When traders get worried that a conflict could mess with the supply from a big oil-producing region, they start bidding up the price. It's basically an insurance policy against future shortages. And what's crazy is that it raises the cost of oil before a single barrel is even lost. And that premium, it has very, very real consequences.
And just like that, the crisis lands right back on India's doorstep. See, for a major oil-importing nation like us, a global price spike isn't just some distant headline. It's a direct threat to our economy.
And this was the tipping point, $87 a barrel. The moment Brent crude, that's the international benchmark, crossed that number. Well, that's a huge psychological and economic line in the sand. It immediately set off all kinds of alarm bells for the Indian market.
So why does that $87 figure matter so much to India? Well, it's because our country is one of the world's biggest oil importers. It's pretty simple. Higher crude prices mean higher inflation, which makes everything from your petrol to your food more expensive. It also widens our trade deficit and squeezes industries that rely on oil. It's this negative ripple effect that, honestly, touches nearly every corner of the economy.
So, faced with this brand new risk, how did the big global investors react? Well, they did what you might expect. They ran for the exits. This next part of the story is all about the flow of money, and more importantly, where it went.
And the exodus was immediate. Foreign institutional investors, the FIIs, they pulled a massive 6,030 crores out of Indian stocks in just one single day. Now, when that much foreign capital flees that quickly, it creates this immense selling pressure on the entire market. What we saw was a classic flight to safety. The FIIs sold off their Indian stocks and moved their cash into assets they saw as safer, things like gold and the US dollar. But here's the other side of that story. Our domestic institutional investors, the DIIs, they did the complete opposite. They actually stepped in and bought nearly 7,000 crores worth of shares, acting as this really crucial cushion that, believe it or not, prevented an even worse fall.
All right, so we've seen the global trigger. We've seen the massive flow of money out of the market. So now let's zoom in and see how all of that actually played out on the ground. Which sectors and stocks really took the biggest hit?
Yeah, just as we saw earlier, the banking sector was without a doubt the day's biggest loser. That 2.15% drop was way worse than the broader market. And there's a good reason for that. Foreign investors, they often worry that high oil prices will fuel inflation, and that could force the central bank to raise interest rates. And of course, that can slow down lending and hurt bank profitability, making the entire sector a prime target during a big sell-off.
And here are the specific names behind those numbers. You've got heavyweights like ICICI Bank and Axis Bank right there among the top losers. I mean, look at this list. It's just dominated by banks and financial services companies. It confirms exactly where all that selling pressure was focused.
But hey, it wasn't all red. Amidst all the panic, some stocks actually bucked the trend.
Defense companies rallied, probably on the prospect of global conflict. And then, in a totally unrelated story, liquor stocks surged, all thanks to a favorable new tax policy. It's just a great reminder that even on the absolute worst days, there are always other narratives playing out in the market.
Okay, so we've looked at the global trigger, the investor reaction, and the market impact. Let's take a second and connect all those dots to see the full chain of events one last time.
So here's the whole chain reaction laid out step by step. It all started with geopolitical tension, which then spiked crude oil prices. That fear drove foreign investors to sell off Indian stocks, and they specifically targeted the banking sector. The end result? A massive plunge in our benchmark indices. It's really a perfect, if painful, example of how deeply interconnected our global economy truly is.
In all of this, it really leaves us with a crucial question, one that every investor has to think about. This whole sell-off was a really powerful reminder that a conflict happening thousands of miles away can directly hammer our portfolios right here at home. So in a world that's this connected, understanding these global ripple effects, well, it's no longer just interesting, it's absolutely essential if you want to navigate the storm.